Does starting a journey to financial success sound extremely daunting? Don't worry if it does, because at one point, I was more scared than you'll ever be. It's going to take time, patience, consistency, and hard work. So join us as we discover a 5-year investment plan and also talk about how to grow assets through smart investing. Before we begin, though, I would really appreciate it if you subscribed for more videos on all things personal finance. Let's start with the basics. Why should you create an investment plan? Before we dive into the specifics, let's address why having an investment plan is crucial. Take the example of John, a young professional in their mid-20s. John has some money saved up and is considering what to do with it. Option A is to keep it in a regular savings account, while option B involves creating a structured investment plan. John chooses option A initially, but after a few years, he realizes that the purchasing power of his money has decreased due to inflation. Meanwhile, option B, the investment plan, sees significant growth. By diversifying investments and considering factors like risk tolerance and time horizon, John's investment plan outperforms the stagnant savings account. This shows the importance of having a plan. It provides long-term financial stability, acting as a safety net for the future. Think of it as your financial GPS, guiding you towards your goals. A well-funded retirement account ensures you can maintain your desired lifestyle even after you stop working. You can't invest without money, right? To begin, it's crucial to figure out how much money you can allocate for investing. A handy way to do this is by creating a budget. Think of your budget as a map showing where your money goes each month, helping you plan your spending and see how much you have left. Start by considering your monthly income after taxes. Then, subtract your regular expenses like rent, groceries, and bills. What remains is your disposable income, the money you can choose to save, invest, or spend. But before diving into investments, it's smart to set aside some money for emergencies. Once you've got your emergency savings sorted, you can see how much of your disposable income is available for investments. Let's say you have $1,000 to invest. Consider how quickly you might need access to this money. Stocks are like quick-to-access piggy banks. You can sell them and get your money relatively quickly. On the other hand, real estate is more like a big safe. It takes time to turn it into cash. Understanding your current financial situation and considering how fast you might need your money is like setting the table before cooking up your investment plan. Now, let's talk about risk tolerance and time horizon, which are key in crafting a 5-year investment plan to build assets. Risk tolerance refers to how comfortable you are with taking risks. Generally, the younger you are, the more risk you can afford to take. Riskier investments offer the potential for significant returns, but they also come with the possibility of major losses. On the flip side, if you're older, it's often wiser to opt for less risky investments. Time horizon is simply when you plan to start tapping into your investments to achieve your financial goals. By understanding both your risk tolerance and time horizon, you can create a robust investment strategy tailored to your needs. Starting early is the next step in creating a 5-year investment plan to build assets. It's like planting seeds for a fruitful harvest in the future. The sooner you start, the more time your investments have to grow and flourish. If you're enjoying everything so far, make sure to subscribe to this channel. Time discipline. Let's talk about time discipline in investing. Research consistently shows that over a 20-year period, investors who stuck to their investment plans earned twice as much as those who kept their savings in cash-like investments. The secret? It's all about time discipline and having a solid investing strategy. Think of investing as a marathon, not a sprint. Starting early gives you a head start in the race, and the longer you're in, the more you benefit from compounding returns, like a snowball effect, where your money grows bigger over time. Sticking to your plan, regardless of market fluctuations, tends to lead to more wealth in the end. Consistency is key in investing. Making regular investments, whether monthly or quarterly, is crucial for your money to flourish. It's like watering a plant regularly. It helps your wealth blossom and reach your financial goals. And while we're at it, diversifying your investments is also essential. Just like you wouldn't want all your players on the team to have the same skills, you shouldn't put all your financial hopes in one basket. Spread your money across different types of investments like stocks, bonds, and real estate to manage risk and avoid heavy losses, especially in volatile markets. And even when it comes to stocks, Make sure to spread your investments out over various industries. Now, let's delve into the eighth wonder of the world, compound interest. When it comes to investing, time is your secret weapon. Instead of just pocketing the returns, reinvesting the interest is where the real magic happens. Let's say you invested $10,000 into an investment making you 7.5% return annually. On top of that, you put in $1,000 every month. Let's say you do this for 30 years. Now, the total contributions that you made were $370,000. Pretty solid, right? Well, the total value of your investment is actually $1.328 million, thanks to the magic of compounding interest. Now let's keep the numbers the same, but instead of a 30-year investment period, talk about a 20-year investment period. By the end of 20 years, your total contributions would have added up to $250,000, and your total investment value would have been $562,000. So when it comes to compounding, time is your best friend. Now let's move on to the next lesson. Don't follow the crowd. Let's talk about the importance of not following the crowd blindly when creating a 5-year investment plan to build assets. Imagine being at a financial crossroads where everyone seems to be marching in one direction, like they've discovered a treasure map. It can be tempting to join the parade, but it's crucial to hold your ground. Benjamin Graham, a financial expert, once said that even the smartest investors need willpower to avoid herd mentality. Look, everyone's different, and everyone has a different level of risk tolerance. So you need to see what actually ends up working for you, not what works for everyone else. On top of that, your investment decisions need to be based on how solid they are, not on what everyone else is doing. Let's say there's a company. Now, this company has an enigmatic founder that uses terms like synergy and whatnot, and everyone's jumping on the hype train, pumping the company's stock. However, you look at the balance sheet and you feel that things don't add up. Maybe the company is leveraged more than it can handle, or maybe there's no proper revenue stream. So resist the temptation to follow the crowd blindly. They might be heading to a surprise party, but you've got a dinner reservation elsewhere. Trust your instincts and stay true to your financial goals. The next thing to consider is monitoring and rebalancing your investments, another crucial step in creating a 5-year investment plan. Your investments are a team, and you want each player to perform at their best. Checking in on your investments regularly is like being the coach, making sure everyone is playing their part effectively. Just as a coach monitors and adjusts strategies to optimize team performance, you also need to monitor and rebalance your investments to ensure they align with your financial goals and risk tolerance. Now that we've talked about most of the keys to a successful investment plan, let's talk about the most important one of them all. Patience is key. The importance of patience in creating a 5-year investment plan to build assets is one of the most overlooked aspects of investing. As the old proverb goes, good things come to those who wait. This wisdom applies to the financial world too. Many investors chase quick profits, but rushing can lead to hefty financial losses. Patience acts as an umbrella during financial storms, helping you ride out market ups and downs without panicking. Patience gives you the space to carefully research, analyze, and make informed choices. Patience allows you to learn from both successes and failures. So instead of constantly checking investments or jumping on the latest market trend, remember that good things often take time. It's not a sprint, it's a marathon. Take a deep breath, let your investments unfold, and watch them grow into healthy profits over the long run. What are you doing to build assets? Let us know in the comments below. If you enjoyed this, please give it a thumbs up and subscribe to our channel for more personal finance and investing related content. Thank you for watching this video on how to build assets with smart investing. Here's to becoming rich and financially free.